We just witnessed a gigantic stock market sell-off. The S&P 500 was down 4.77% on the day and is still selling off after hours. The NASDAQ 100 sold off 5.35%. The Dow Jones Industrial Average sold off 3.98%. And even popular dividend ETFs like SCHD sold off over 4%. And unless you've been living under a rock, then you know this is due to the newly announced tariff policy. I just made an entire video giving my initial impressions on that. But now today, we get to dive into the aftermath. And it is no doubt one of the most interesting days investing in the stock market I've seen in many years. If you're wondering why the index is down so much, it's because many top companies have sold off far more than that. Just as an example, NKE Stock is down 14.4% today. Another example, the top holding in the S&P 500, Apple, sold off 9.25%. So today I'm going to analyze 4 top stocks that just sold off big time. And I'll answer the question of whether this could be a buying opportunity right now or whether you should wait and see for more information. And I'll give you a little bit of a hint. Of the 4 stocks, I put 2 into the wait and see category and then 2 into the buying opportunity category. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Every month I give you an update on my personal dividend growth stock portfolio, and every week give some stock analysis content. And if you're wondering how my dividend growth portfolio did today during this huge sell-off, it was down 3.34%, so I actually fared far better than the market indexes. And the reason why is I'm heavily concentrated in my top 3 holdings, and they did relatively well today. That's Visa, that was down 2%, Microsoft down 2.36%, and the Altria Group, which was up 1.35%. However, I also had some pretty big laggards in the portfolio and some stuff that sold off big. So I will likely do another follow-up video going over the top dividend growth stocks to buy right now. But today I'm going to take a broader look at the overall market so that we can properly analyze this whole tariff sell-off. Don't worry, there will still be some dividend stocks mentioned. And as I jump into these top 4 stocks selling off, I'm going to be using my research tools over on dividenddata.com. This whole platform is basically designed to help you find better investments. So if you're interested in that, go check it out. There's a 30-day money-back guarantee, so no risk in trying. So first, I'm going to mention Apple, ticker symbol AAPL. This is the #1 stock in the S&P 500, and it sold off 9.25%. So if you're invested in the index, this is the reason your portfolio is getting crushed today. And the #1 reason why that stock is going down is over tariffs. So I just asked my AI analyst to summarize the tariff news around Apple and highlight where they get their products manufactured and how they'll be impacted. So this 9% crash was the worst single-day loss since September 2020 for Apple stock. They lost approximately $311 billion in market value. These tariffs are going to have a big economic impact on the company if they don't get any exemptions, which it seems like right now they're not going to. And the reason why is they manufacture heavily in China. That's where they produce and assemble the iPhone and MacBook. Currently, the new proposed tariffs have a 54% tax rate on imported goods from China. Apple also manufactures in India and Vietnam, which are subject to tariffs of 26 and 46%. And as we analyze tariffs, this really impacts physical goods, so hardware products, and that's where Apple makes a lot of money. If we look at last fiscal year, 51% of their annual revenue came from the iPhone. That's over $200 billion. So as we analyze Apple's business, the iPhone is really the cash cow, and basically 75% of their business is hardware based. So that means tariffs, if implemented, will really hurt the cost structure of Apple's business. Now, lucky for Apple, which kind of already was the bull case anyways, is their service business, which is now nearly 25%. And this is kind of high margin software services that would not be directly impacted from these tariffs. And it is increasingly becoming a profit-generating part of Apple's business. If we do a little more research about Apple's services business, in the latest quarter that hit all-time high revenue of $26.3 billion, which is a 14% increase year over year. So if you've been investing in Apple, a lot of your bull case is around that services business. This also is a very high gross margin business compared to hardware, with a gross margin of 75%. But still, the overwhelming majority of Apple's profits come from the iPhone. And they are in a tough situation with these tariffs. Now, luckily, Apple's hardware business is high margin, especially relative to their peers. But still, this increase in cost because of tariffs would either mean they make less money or they have to raise prices on consumers, which could lead to less overall sales. And Apple has already been facing problems with sales growth. For example, if we look at Apple's revenue, they basically have been flat for the past 4 years. So when you take all of this into account, it becomes pretty clear why Apple stock is down 9.25% today. And personally, I have long viewed Apple stock as being overvalued. Don't get me wrong, it's a fantastic business, but they've been trading at a premium valuation and not really growing in recent years. Prior to this tariff news, analysts were projecting accelerated earnings growth in future years, but now even that becomes less clear. If these tariffs do come in place, Apple could be in for a lot of trouble because basically they've been around flat at $100 billion of free cash flow for the past 4 years, and a lot of their stock price performance is basically kind of juiced from stock repurchases. For example, in fiscal 2024, they bought $94.9 billion of share repurchases. As you can see, they've just dramatically decreased their shares outstanding over the past decade. And right now it's declining by about 3 to 2% a year. So I would not be buying the dip on Apple stock right now. This is definitely, in my opinion, in the category of wait and see for more information because they really could see a lot of disruption from this. But if you are planning to buy the dip, or if you're just a shareholder in Apple in general, you really should be hoping that they get an exemption on these tariffs. We already know that Tim Cook has been talking to Trump. And if we go back to 2018, they did get exemptions on the Chinese tariffs at that time. However, as of the making of this video, that is not happening so far. So I imagine Tim Cook is calling his ass off today. With stock number 2, we have another iconic American brand, which is Nike, ticker symbol NKE. They just sold off 14.4%. That's crazy, especially when you consider that they're now down nearly 69% from their all-time high. This is the lowest stock price for Nike since 2017. And let's get into the reason why. And this one is pretty obvious. Nike gets their products manufactured overseas, most notably in Vietnam and Indonesia, and they still have a presence in China. As I mentioned earlier, there was just a 46% tariff announced on Vietnam. So this is going to be a ton of pressure on a company which was already going through a very poor time. This is going to increase their cost. They will likely need to raise prices to account for this increase in cost, which will likely hurt sales. And they may even have to consider reshoring some of their supply chain. Although with clothing, it's pretty hard to compete with that due to higher labor cost. So unless they can figure out some way to highly automate the manufacturing process so that it would make sense to bring to the US, Nike is going to be in a pretty rough situation. However, this company was already in the middle of a turnaround, and the stock price is already beaten down to severe low levels. So if there ends up being some separate bilateral trade agreement with Vietnam that makes sense for a company like Nike, then this could be a pretty interesting buy the dip moment where you get a high quality business at a relatively low valuation. Nike is a dividend growth stock with a 10-year compound annual growth rate of the dividend at 11%, and that dividend is sustainable based on their free cash flow and payout ratio. They have a 32% free cash flow payout ratio based on fiscal 2024. However, that is going to be worse in 2025, and with this tariff news, who knows, it could be even worse in 2026. So a highly sustainable dividend could be getting towards the territory where maybe they consider cutting it, especially if they have to do large capital investments. But I'll tell you what, prior to this tariff news, I was pretty secure that based on the fundamentals of Nike, their dividend is safe. They just announced an 8% dividend increase, even with knowing that 2025 was going to be a bad year. And in the year prior, they had an 8.8% dividend increase. And by the way, Nike stock is now at the highest dividend yield of all time. So if this sell-off continues from purely a dividend yield standpoint, this could get to be a pretty interesting buying opportunity. But a lot of that depends on how the tariffs impact their business model. Nike does have relatively high margins, but they've already been negatively impacted as they're in the middle of a turnaround and they've been discounting old inventory. So Nike is going to be in some problems. So right now I look at Nike as in the wait and see category because this really could impact their business and I would want more information before making an informed decision. And as we go back to my dip finder for the day to see what stocks on my watch list sold off the most, I'm going to share 2 big tech companies that sold off nearly 10% and that I think are actually buying opportunities right now. One of them is a dividend growth stock, and the other one does not pay a dividend, but is a great business. For stock number 3, I am going to pick Amazon, ticker symbol AMZN. Their stock was down 8.98% today. This brings them down 18.99% year to date, and 26.3% down from their all-time high. Meanwhile, the actual business of Amazon is doing better than ever. They just hit all-time highs of quarterly earnings per share at $1.86. And based on earnings per share over the trailing 12 months, the company is trading at a 32 PE ratio, And this is a company where analysts are projecting 20% plus earnings per share growth year after year. So this is kind of a great buying opportunity. But first, let me just talk about tariffs and why the stock is down 9% today. Obviously, Amazon's one of the biggest e-commerce companies in the world, and a lot of the products they sell on that store are manufactured overseas. That is both products that are Amazon basics that they sell and products from third-party sellers that are sold on Amazon. So the bear case is that this could put a lot of pressure on third-party sellers on Amazon, and maybe some could go out of business entirely. However, what I personally think is going to happen is that prices will kind of just go up on the platform. And from a competitive standpoint, I think the e-commerce side of Amazon will still be very strong, and they will be a market leader in the category, because US consumers will still be shopping, and Amazon will be one of the prime locations in which prime. I said prime there. It will be one of the prime locations where people reliably, conveniently, and relatively affordably buy products. And that's kind of no matter what the prices are. So some products sold on Amazon may start increasing in price. But if you've ever heard someone analyze Amazon stock as an investment opportunity, they never talk about the e-commerce business, because that's not where the bulk of the valuation comes from. Now, part of it comes from the platform they've built on top of that e-commerce business, but then also Amazon Web Services. So let's talk about that. If we look at Amazon's business, their e-commerce segment, in terms of what they actually sell on the platform, is a large part of their revenue. But in terms of profitability, this is very low margin. So it has a very low multiple assigned to it. So it's actually not a big part of the valuation for Amazon stock. However, what is all the services they build on top of that. So that's their third-party seller services, which is a big part of their revenue. And I also know they've increased fees a lot in this category over the past few years, which sellers are complaining about. So that adds a little bit even more economic pressure on top of tariffs. But then you also have advertising services. So this is when you search something on Amazon and there's advertising recommended products in the search results and then suggested. And this is a huge high margin business for Amazon. So that's a big part of their valuation. Then you also have subscription, which is Amazon Prime and that whole ecosystem. And that also is a big part of their valuation. Similar to how in Costco's business, the Costco membership is a big part of why they trade at such a high multiple. Subscription services are very valuable. But then the real contribution to Amazon's business is Amazon Web Services. It may not seem like a lot at just under 17% of total revenue, but Amazon Web Services is a major profit driver for the company, which is about 58.1% of their operating income. And this is also still a very high growth business, and they are the market leader in cloud ahead of Microsoft Azure and Google Cloud. But all three of those businesses are going to grow a ton in the future. And there's this big AI super cycle that is going to continue happening despite what goes on with these tariffs. So as I look at Amazon stock, I view this 9% sell-off as more of a buying opportunity for one of the great big tech companies and companies in general in the world. And finally, for stock number 4, we have Meta Platforms, ticker symbol META. They were down nearly 9%. This is the parent company of Facebook, Instagram, WhatsApp, and whatever they call their virtual reality thing these days. Once again, one of the best big tech companies in the world. They just hit all-time highs in earnings per share. In the latest quarter, they had $8.02 in non-GAAP earnings per share. And as you can see, they've been growing rapidly in recent years. And analysts are projecting double-digit earnings per share growth in each of the coming years. And you might be saying, this is a software company. Why would tariffs be making this go down? Well, the way they monetize that software is through advertising. They are one of the largest digital advertisers. And fears have gone up of a potential recession, which remains to be seen. And in that scenario, advertising could potentially be impacted. And also a lot of the products and services on Meta platforms that are advertised are e-commerce. Think about Instagram, Shop, and all that kind of stuff. It's a lot of low-value products that are manufactured overseas. However, I am in the camp of thinking this is a buying opportunity, and that's because this is one of the best businesses in the world, and there is a huge AI trend that kind of just powers their entire flywheel of their business. Meta's revenue per share has grown at 30% 10-year compound annual growth rate. Free cash flow per share has grown at a 31% 10-year compound annual growth rate. And in the most recent year, they just grew free cash flow per share at 25%. The company has a great balance sheet, and they are a new dividend payer because they are so highly profitable. Right now, this is under a 10% payout ratio. And likewise, the dividend yield's very small at the current price at 0.4%. They just announced their first dividend increase at 5%, and I think over the long term, this will be a dividend growth stock of the future. And Meta is a platform I'm considering adding to my dividend growth stock portfolio. Prior to the tariff news, the consensus price target among Wall Street analysts was $689.47 on Meta stock. And based on today's price, that implies the company is 30% undervalued. Even with this recent sell-off, the company still has a 5.3% total return over the past year, and that's 128% over the past 3 years. And in general, I think this will be a great compounder in the stock market for decades to come. So let me know in the comments below what you thought of the 4 stocks I highlighted today and which you think are buys and which may be wait and sees. And if you want to use the stock research tool I showed today, all of this is available at dividenddata.com. That includes our AI analyst where you can ask investing questions sourced with real-time financial data, and of course our stock analysis tool and portfolio tracker. All of this is available at dividenddata.com, so click the link in the description and pinned comment to check that out. With that said, thanks for watching, and I'll see you in the next video.